Hello and welcome, champions, to Financial Advisor Pro. My name is William Moon, and in this video, what we're covering is what are mutual funds and IRAs, how do they work, and what's their relationship together? So let's go ahead and start with this here. What is a mutual fund? If you could look at a mutual fund, it looked like this here, a big square with some little squares inside of it, and each of these squares represent different stocks, like in the stock market. Now, I don't always like using the word stocks because people think risk, lose your money, go to the bank or the credit union, but then your money's not going to grow at the same time. Okay. And so what we refer to these stocks as is companies because all stock means in like the stock market is that you own a little piece of a company. And so these are companies inside of a mutual fund. This is just for illustration and education purposes. This is not a recommendation to buy or sell any kind of stock or bond or mutual fund or anything like that. Okay. So for example purposes, this mutual fund could have Walmart, Target, Sam's Club, Costco, McDonald's, or Burger King stock inside of it. Okay, just as an example. Now, the way the whole economy works is if a company is doing poorly, right, and they're not doing what they're supposed to be doing, which is selling goods and services, the value of the company is going to decrease. And also, so is your account balance, it's going to decrease in value. But if the company is doing well, because maybe in this example, people might be shopping less at Target, well, they still have to eat groceries and buy food, so they're going to shop somewhere else, right? It just might not be at Target. Okay. So in this example, if they're shopping at Walmart more, Walmart increases in value because there's sales and things like that at Walmart. The value of the company becomes more valuable. Well, then your account balance is going to increase in that example. Okay. And so that's how the whole economy works. Okay. Is there's lots of companies fluctuating up and down or staying flat and things like that. The main reason to have a mutual fund, because we know that this happens, the one guarantee is there will be market fluctuations, is for the principle of diversification. You don't want all of your eggs in one basket. You want a diversified mutual fund because a diversified mutual fund on average has 80 to 200 different companies inside of it. So you don't have all of your money in one company. So if it went bankrupt, right, then which that's happened many times in history, well, you don't have to worry about it because the winners will offset the losers. Okay. And so that's the main reason we use mutual funds. The second reason mutual funds could be a valuable asset for growing your wealth is because there's a professional money manager who manages the money. And these are the individuals, this is usually actually a company. A money manager is usually a company, and they hire professional money managers to actually watch and monitor the portfolios. And they'll, for a small fee of every time you invest money for a small fee, they'll manage your money for you. Okay. And so they get all the data from like GDP and stuff like that. They get all from the source, these financial statements from these companies and things like that. And they get all this information and they're very well educated, like masters or PhDs in economics, and they'll choose which companies are the best companies to have in your mutual fund. And if a company is performing poorly, they'll have the ability to take that money out or that stock out of your portfolio. So it's very valuable to have a diversified mutual fund while working with a money manager in a mutual fund. The third thing is because you could use mutual funds for a lot of different things. Like it could be used for an IRA, which we're going to get into in a second, for retirement. It could be used for an emergency fund. It could be used for college education savings plans. You could use mutual funds in all kinds of ways, right? And the benefit of them is it's not like a CD where your money is locked up and you can't access it. You know, you actually have liquidity in a mutual fund. You can have access to it as well. Just depending on the type of the account that you have, we don't always recommend that being super liquid. Like if it's a retirement account, you want it to stay in there. But for other reasons, you could use a mutual fund and it could be very liquid to get access to really quickly. Okay. And so the thing is, you have to know that the stock market, it's like walking up a flight of stairs with a yo yo that's going up and down while you walk up and down. Because you see, even if you were to sell off your shares at the high point of the market of the stock market, let's say 10, 15, 20 years ago, instead of maybe we might be at a low point today, it's still higher today than it was 10, 15, 20 years ago. Okay, and so that's how the stock market works. But through these time tested strategies of diversified mutual funds with a money manager and having liquid access to them if you need them, that's why mutual funds are superior investments for the average family for wealth building for your future. So there's different types of accounts that you could partner with a mutual fund. Now, when it comes to deciphering the difference between accounts and mutual funds, okay, I like to think of it like this, very simple. An account is the body of the vehicle, okay, that you have. The body of your vehicle, okay, in this example could be a traditional IRA, a Roth IRA, a college savings program, right? Or an emergency fund, okay? Now, every vehicle, right? The body of every vehicle has an engine inside of it. Your engine is your mutual fund. It's what actually drives your rate of return. It's what actually earns you money, okay? And so we pair those together. The account is the body, the engine is the mutual fund. Okay. All the account says, the body of the vehicle or the account says is, hey, how's this money taxed? Okay. So, for example, this is really important because if you had a traditional IRA, and let's say that you over time invested $10,000 into a traditional IRA. What's nice about the contributions into a traditional IRA is you could deduct that from your income. So you actually might pay less in your income taxes depending on your tax situation. Okay. And so traditional IRA contributions are tax deductible because you could anything that you put in, you could reduce your income by. Okay. Now let's say though that over the lifetime of this account, let's say it comes retirement time and you want to pull money out of this traditional IRA, and let's say it's at $100,000, okay, that the account balance grew, it's now $100,000. Congratulations. Well, if you take that money out, Uncle Sam has not gotten their piece of the pie. Okay, this money has not been taxed yet, and so $90,000 is not taxed. Okay, so when you pull money out of a traditional IRA, the growth of the account balance is going to be taxed at whatever your tax bracket rate is at retirement. Okay. But you do get the benefit of deducting your contributions into your traditional IRA from your income. Okay. So that might be a good thing for you. Okay. It may or may not. Okay. Now, you could also invest potentially into a Roth IRA. Roth IRAs are slightly different because, let's say, again, same situation, you put $10,000 in this account over time, right? Now, a contribution to a Roth IRA is not tax deductible. I want to be clear about that. You cannot deduct the money you put into a Roth IRA. You can't deduct that from your taxes. Okay. However, one of the really big benefits of using a Roth IRA, same situation. Let's say that money grew to $100,000 because really you funded this, that $10,000 that you funded your Roth IRA with, it's with after tax dollars. And so this is a special law that the United States government put into force to incentivize people to save more money. The beautiful thing about a Roth IRA is when that money grows to $100,000 and you take money out for retirement, that is tax free distributions. Okay. You're not taxed on taking money out of this account because you already paid with after tax dollars. Okay. So, how do you know which one is better for you, a traditional IRA or a Roth IRA? Well, there's some things to consider depending on your tax situation, how much income you make and things like that. What are your goals and things like that for the future? And so, folks, this completes our video. And so, I want to encourage you guys to make sure to, above this video, make sure to schedule a consultation. So that way you could find out from a licensed professional which one is best for you, a traditional IRA, a Roth IRA, and what kind of mutual fund to put inside of it. There's a lot of things that we look at, and we'll know very, very quickly what is the best thing for your scenario. So thanks for watching this video, and we'll see you all on the other side.